You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Hello, everybody. This is Buck Joffrey from the Wealth Formula Podcast, and today I've got an interesting interview with a guy by the name of Jorge Newberry of the American Homeowner Preservation Organization. So I met Jorge at our recent meetup over in the North Shore of Chicago. By the way, if you're interested in ever meeting us in person, go to meetup.com and go to the North Shore Private Investor Group. Anyway, Jorge's a really interesting guy with an interesting story. He started up this company that is essentially a type of hedge fund that deals with essentially buying mortgages from struggling companies and or struggling homeowners, and helps them stay in their house, and also helps to make some money along the way. It sounds like a good investment. The minimum contribution is not significant, so it certainly might be worth looking into, and the returns are pretty darn solid. So without further ado, here's my interview with Jorge Newberry. So I have with me today Jorge Newberry from American Homeowner Preservation, and you are the founder and CEO of this organization. Jorge, why don't you tell us all about what exactly this organization is?
We create a series of closed-end funds which purchase pools of defaulted mortgages from banks. We'll buy from Citibank, GMAC, Aurora, other types of banks such as that. And once we acquire the loans, we'll go to the families, the borrowers whose loans we now own, and we'll offer them solutions to stay in their homes if they want to stay. They'll get a modification. Because we bought the loan at a big discount from the banks, we can offer transformative solutions. Let's say someone owes $100,000 and the home is only worth $50,000. We can often, we probably bought that loan at $20,000, so we can discount the principal, drop the payment, and offer very attractive terms, which will, in many cases, enable the families to stay in their homes. But if they don't want to stay, or let's say the home is already vacant, then we offer a cash incentive to cooperate with a deed in lieu or short sale in order to avoid the foreclosure process. And then ultimately, there are some who ignore us completely, and we do end up foreclosing. But the goal is to both deliver a social return, have a positive social impact, and also generate strong financial returns.
That's great. Now, you guys didn't always start. I was just looking at your website, which is AmericanHomeownerPreservation.com, and it sounds like you actually started from a nonprofit perspective. Can you tell us about that?
Yes, we started in 2008. We were originally a 501c3 nonprofit, and our mission was to keep families in their homes. And what we would do is families would come to us, and they had a loan with Citibank, Bank of America, Wells Fargo, whoever the bank was. And we would go one by one to their lender and try to achieve a resolution. And repeatedly, the banks would deny the resolution. And instead of keeping the family in their home, they proceed to foreclose. And we would track these. And many a times, the bank would ultimately sell the property for less than what we could have delivered them and kept the family in their home. If let's say, using the same example, they owed $100,000, the house is worth $50,000. We may have offered the bank $45,000 or $40,000, and instead the bank chose to spend $4,000 or $5,000 to foreclose, take another year, kick the family out. Home becomes vacant, sometimes gets vandalized, and then they would sell it for $35,000 or $30,000. And this would just happen over and over. So we thought, hey, the only way this is going to work is if we take the banks out of the equation, if we actually buy their positions. And on a one-off basis, there was very little reception from banks. We had success maybe 1 in 10 times. But when you go to the banks and say, I'll buy your defaulted mortgages, and they'll give you a pool of 100 or 200 or 1,000, then they're prepared to take those discounts that are needed to move those loans. One big change was, though, initially we had families coming to us and we would go to the banks and try to work on their loans. Now the banks come to us and give us 100 loans whose homeowners whose borrowers we have no contact with, and we're not even allowed to have contact with until we acquire the loan. So we really have very limited insight into what the family's intentions are until we actually acquire the loan.
So I guess initially you weren't really looking for large sums of money. You were actually acting more as sort of an intermediary for these families with the bank. Is that right?
That's more or less right. We actually had proposed municipal bond financing to acquire the homes and allow the families to stay. That was the original plan. So we would go through banks on a short sale, acquire the homes, and then the nonprofit would own the home, allow the families to stay at a discounted rate, and then eventually allow the families to repurchase the home. That was the original plan, and we actually had an inducement from Summit County, which is the Akron area of Ohio. They induced us for roughly $13 million worth of bonds to do this, but because the banks, despite the fact that we had capacity to raise the money through tax-exempt bonds, the banks were not receptive, and we couldn't find a way to really make it work under that structure. So we weren't raising investor funds. It was all bonds at that time was the plan. But so what happened though is that although the banks rejected us the majority of the times, there were a few that they approved, and although it was nowhere near the $13 million that we had proposed for bonds, we did have some homeowners where the bank said, okay, we'll make a deal. And so now we had several of these, not very many, but we had several of these, and we started thinking, well, now we have some approved. We can't do the big bond issue we anticipated, so what do we do with these families? And we were looking for financing for nonprofits, and this was late 2008, early 2009, when the financial markets were in crisis, and to get financing for a nonprofit was extraordinarily challenging. So I remember we had a conference call with some investors and private investors, and we said, we're looking to get financing, and some of them were interested. Maybe we'll do mortgages, but they were in California, and this was in Ohio, and they weren't licensed to do loans in Ohio. So there was a lot of challenges as we explored that. And then one of the investors said, well, heck, I'll just buy the house. Let me just buy this house, and I'll let the family stay, and I'll lease it. And when they're ready to buy it back, they can buy it back. And we predetermined the purchase price. So the investor bought it for $50, then the homeowner could buy it back for, let's say, $57.5. So there was an upside for the investor in addition to the monthly rent, but it wasn't, I buy it for $50, I'm going to sell it to you at $100, which would be not attractive for all parties. So we tried to make it predetermined, and the returns were good. We did one, and then we started doing several, and actually that worked. But we were still at the mercy of the banks in terms of approving these. The approval rate was still very modest, so it wasn't a viable model. And at that point, to sell these to investors, we had to convert to for-profit, and that's what we did. But although we were for-profit, we were still really not making a profit. So it really it was doing some social good, but it wasn't a structure that really worked, because we had to work on 100 files to get 10. And, we had a lot of staff hours went into those files that didn't close, so it wasn't very efficient.
So your initial involvement was really sort of not an intention to really make a lot of money. Is that right? You kind of came into you basically as a social cause. Is that right? What's your background? I guess that's a good way to ask. So how did you even think about getting into this whole this area of trying to keep people in their homes? What positioned you there?
Well, I had worked, I've been in real estate since 1990. I was originally a loan officer, and then I started with a partner, we started a mortgage company, which is still in existence, in a real estate brokerage, a property management company. I eventually started developing properties, and I built a pretty large portfolio, about 4,000 units across the country. But I had one complex, which was the biggest complex, which suffered it was devastated by an ice storm in 2004. It was 1,100 units, all in one complex on 52 acres in Columbus, Ohio. Up until then, I was on a roll. I was doing really well. I had a series of successful turnarounds of big troubled projects. And in fact, this project, I had a commendation from the Ohio House of Representatives for the good work that I'd done in turning it around. It was called Uzi Alley before I bought it, and by the time I was done, it was turned into a very, I won't say desirable property, but it had stabilized and turned into something that was an asset to the community. It wasn't the crime magnet that it was before. In late December 2004, there was an ice storm, and it created severe challenges at that property. And we ended up in a battle with the insurance company and eventually the city. We spent 11 months trying to get an insurance claim, which was denied. And eventually we went to court. We were able to settle. But by that time, the city had issued orders, emergency vacate orders. Long story short, it created a huge challenge for my portfolio, and I ended up in severe financial strain. And my response to that was, I should say, my life somewhat changed, and I still have a profit motive, no question. I'm not going to hide that. I would like to make good money, and right now we make good money doing what we're doing. But there is also a mission to right or wrong, where these families, I think, didn't realize what they were getting into in lots of these cases. I mean, what happened in 2008 was so many of these families had rates that had gone up and their income was going down, and it was the perfect storm of challenges which created all these foreclosures, and so it seemed like an opportunity to do something good and hopefully eventually make at least some money out of it, and it's gone that path. It's evolved many times. In 2011 when we started buying loans, we had so much success that the lender on the Woodland Meadows loan, he used to work for Allstate Insurance.
That's the one that got destroyed?
That's the one that got destroyed. Mm-hmm. But we ended up paying back, it was challenging, but we ended up paying back the lender in full. And he remembered that, and we stayed in contact. And we, as this AHP started growing, he thought, why don't you come to Chicago and we'll create a hedge fund to do this? And he had more resources, I think, than I did in terms of institutional money. And so I went ahead and we moved to Chicago. We started the hedge fund, and we had some success, although there were limitations in the hedge fund structure where AHP would get 20%. It was typically hedge fund structure. AHP would get 20%, the investors would get 80%. We'd also get a 2% management fee. And the management intensive nature of what we do, it just didn't work very well. We did very well for investors. The returns in 2012 were over 14%, same with 2013. But we weren't doing very well. We had done better when we were in Cincinnati, which is where we started. And there, we simply did 50-50 deals with our investors, which pretty much worked. But the 80-20 didn't work. So now we've transitioned to a crowdfund structure where investors go online. They have to be accredited, but accredited investors go online to our website. And our website's actually ahpinvest.com. They can go online. They can invest from $10,000 on up, and they can earn returns of 9% if they invest for a year, 10.2% if they invest for 2 years, or 12% if they invest for 5 years. And using those monies are then used to purchase specific pools of mortgages.
Are those you're talking about annual returns?
Those are annual returns, correct?
So you get a monthly check essentially that that's going to add up to whatever 12% if you went for 5 years or whatever. It's not like a quarterly. It's not a preferred rate. Blah blah blah. But that's kind of what the standard return is. Correct.
So basically, the revenues that come in from whether it's payments or sales of properties, all that money comes in, and then it's distributed first to the 9% investors to pay their return, and then to the 10.2% investors, and then to the 12% investors. So all the returns are paid. Whatever cash is left is then paid to return the capital to the shortest term class, which initially would be the 1-year investors, and they're all paid this extra money each month until they're paid off. And then we go to the 10.2% investors, pay them off, and then the 12% investors pay them off. And our incentive is whatever's left at the end, that's our incentive. So our goal is to pay the returns to investors as soon as possible and return their capital. And once that's done, there's $100,000 in less.
When you say return the capital as soon as possible, what do you mean? So if, say, for example, I invest, we're using the number $100,000 into something that the return is 9%. So if you're, or no, let's use the example of the 5 years. Okay, so you said like 12%, right? So what good does it do to return something faster? I'm confused about that, because if you're in for 5 years, don't you just keep getting your 12% for 5 years and then get your principal back? Or what exactly, how would that work for a 5-year investor?
So the structure, it's a maximum of 5 years, but our goal is to pay you back sooner. And it won't be one lump sum payment in all likelihood. You're probably, let's say the 9%ers, or let's say the 12, you're using an example of the 5 years. I would expect sometime in the second or third year, we'd have paid off the 1 year and the 2 year investors, and now whatever extra revenue there is each month will be used to pay back the investment, not just the returns, but now actually return the investment to the 12% investors. We're not looking to, if we get money back, we can't reinvest it. So if it sits in a bank account earning, next to nothing, no good, and we don't want it. We really want to pay it back to the investors and make sure everyone gets their return and their money back. So that 5 year investment, there's a good chance it may be back sometime in the fourth year, or even in some cases, depending on the velocity of how fast these loans turn, could be in the third year.
Okay, so essentially what you're doing is if we use the example of the 5 years again, and I'm just trying to
Sure.
approach this as an investor. You say, okay, I put $100,000 in, starting from month 1 or month 2 or whatever. The first month, I start getting a return that's annualized at 12%. Along with that, I will be starting to get some principal back, or at some point when you guys have the money, say it's 3 years, I'm going along, I'm getting 12% every month, and all of a sudden I get my last 12%, and then my principal gets returned, and then we're done. Is that?
Not completely. Let's say, for instance, on a $100,000 investment, 12%, $1,000 a month. So in all likelihood, you'll receive $1,000 a month for the first year, $1,000 a month for the second year. Then sometime in that third or fourth year, you'll start getting more than $1,000 a month. You'll start maybe receiving $2,000 a month or $5,000 a month. And the amount that's over the 12% is a return of your capital. And that's paid until you're paid off. And let's just use a round number. At the end of 3 years, your $100,000 investment is now $80,000 because you've received $20,000 return on your capital. And that is, so now your monthly payment has dropped from $1,000 a month because it's 12% on whatever's outstanding to $800 a month because you've already received $20,000 back. Okay. So that's where our goal is, to return your money, because the money is a cost and expense. So the sooner we pay it back, the better.
Right. So, okay, well that makes sense. So a couple questions here. So where are you targeting? Is there geographically? Is all throughout the country? Is it I noticed you had something on your website currently about Brooklyn or something like that.
Yes, we just closed our first big pool that was using the crowdfunding structure, and the new pool has a lot of Brooklyn. The biggest concentration of loans is in Brooklyn, New York, and these all came from Lehman Brothers. Lehman Brothers was the biggest bankruptcy in U.S. history in 2008, and that bankruptcy is still being wound down. And here's the majority of these loans are coming out of that bankruptcy. And the majority happen to be in Brooklyn, New York, but they're scattered all over the country. There's one out here in Lockport, Illinois. There's a couple others in Illinois, but a big concentration in New York. And notably, many of these loans severely underwater. They owe considerably more, in most cases, than what their houses are worth. Many of them haven't paid in years. And what we find is you look at someone, I haven't paid in 3 years. Why would these people just don't want to pay? But then you contact the family and say, no, I was trying to pay. The bank wouldn't take my money, or I was trying to do a mod. They took 2 years of my paperwork. They kept losing it. And it seems it seems preposterous that how could these have gone on so long with a family trying to make a deal to stay in their home and the bank just not doing it. But the reality is that's happening repeatedly and on a massive scale.
Yeah, and it's interesting because I think a lot of people seem to think these types of things are kind of going away, right? I mean, it's 2000 and it's almost 2014 as of today, and we don't hear very much about it. But it sounds like is there another wave coming? Is some of these arms that were done? Is that what's going on, or what's is it just as rampant as it was 2 years ago, or?
I wouldn't say that it's as rampant as 2 years ago, but it's still a much bigger problem than I think most people are aware of. It's no longer on the headlines. It used to be on the news all the time, and on CNN and in the headlines. Right now, it's kind of an old story. But just because it's old news, the problem hasn't gone away. In the last year, there's been some appreciation. There's no question around the country, but the appreciation has somewhat been geographically inconsistent, and also the higher value homes and the middle income homes, those homes have definitely seen a boost in their pricing. But then you go, for instance, Southside is sold for $15,000 a year ago. You foreclose on the same home on the same street, it's still $15,000. There's very little, no appreciation there. And the problem is still of such a titanic proportion. There's $566 billion of underwater mortgages in this country. So that's I don't know how many mortgages that is, but it's going to take, I'd say, at least another 5 years to work through just the problems that we already have. And then, the economy is still sluggish in most sectors. And I think that, families, if inflation adjusted, are making less than they were 5 years ago, less than they were 10 years ago. And until that problem changes, I think this problem is going to continue. And to wit, we've started seeing some situations where we'll buy a loan that was originated in 2012. And you're saying, hey, it's 2013. This is a brand new loan. How to go bad? And we're buying it at 50 cents on the dollar. And so that certainly, that's not going away. And I think time passes, people get laid off, wages get reduced, and that continues to happen. And some of those 2011, 2012 loans will continue to go bad, probably not at the rate of 2008 vintage loans, but nevertheless, this country's economy needs to turn around. And not to ignore the fact that there have been signs of some recovery, but most families, I think the majority of families in this country, would say they're no better off today than they were a year ago or 2 years ago or 3 years ago.
Sure. What's the implications of an appreciating market to your business model?
People ask that all the time. It's a good question. But an appreciating market will result in us paying a higher prices for the loans. And what we pay is always based on the value of the loan. So, the value of the home that's security for the loan. So if a home is currently worth $200,000 and we agreed to pay 50 cents on the dollar, it's 50 cents on that value. The presumption is that the loan is higher than $200,000, so we would pay $100,000. Now in 6 months, if that house is worth $250,000, then we're paying $125,000. Likewise, in 6 months, it's worth $150,000. We're paying $75,000. But for those types of fluctuations, and I probably used my example as a little bit too wide of a range, but let's say there's a 10 or 15% range. To the extent there's those fluctuations, whatever inventory we have, whatever loans have now turned into deeds in lieu or REOs, and we're now selling that inventory. If we're selling it, the market's appreciated, we're selling it at a higher price than we anticipated. If it's dropped, we're selling it at a lower price. But since we buy them typically around 50 cents of current value, there's some pretty good insulation. Even if the market drops 10, 20%, then we're okay. If it goes up 10, 20%, then we're in good shape.
Right. So just out of curiosity, now, in terms of buying these kinds of mortgages, I can't go off the street and go to a bank and say, hey, do you have any mortgages you want to sell? I can't do that, right?
You can't. And it's a very opaque business. When we started saying, hey, we want to buy loans, we started calling people, and we really had very little success initially. And it's a very, unfortunately, it's kind of like an exclusive, I wouldn't say exclusive club, but it's not easy to break into. We ended up finally hiring a consultant who had just been laid off from one of the bigger servicers in the country, and he was the CEO there, and I contacted him. I saw a news article that he was laid off. I contacted him and said, hey, I need to get introduced to some of these funds and sellers of mortgages. So he agreed to help us out and introduced. I flew to New York. We met a bunch of people, had some conference calls. And I have to say, most of those calls, I met with some of the biggest banks in the country. And even so, most of those introductions went nowhere. But there was one who ended up selling us a small amount of loans and then a larger amount of loans. And all of it, over time, we became a buyer. And now people actually call us and say, hey, we know you buy these loans, and here's what I have. And they could be selling one loan or 100 loans. But it is very difficult for an individual investor, or actually even a company, to say, I want to do this and break into it. Once you break into it, there's a pretty ample supply of loans available.
One of the things I always look or ever consider a loan is to find out of your team, I guess, how much skin in the game do you guys have yourselves?
We don't put much skin in the game at all. Our documents require that we put in $10,000 on every pool. I'll tell you, the pool we closed on that we just closed this week was about $4.6 million. We put in about 5%, so about $230,000. So I guess that's not a little amount, but it's
something.
Still, yeah, it's something. Then we'll do the work, and basically we get paid at the end. So we want to get our investors paid off, and they get paid back at the end.
Just for clarification too, Jorge, one of the nomenclature here, you mentioned the word crowdfunding. Now, that has some specific meanings as of the recent Job Act. But we're not really talking about the crowdfunding that limits people to $2,000 per year, limits them to 2% of their income. You're talking about old-fashioned fund investing, correct?
Yes, this is fund investing. I guess when we use crowdfunding, it's when we had a hedge fund, the minimum investment was $250,000.
Right.
Today, we take a minimum investment of $10,000. So that's a drastic difference. And, it has some cost to it, accounting costs and some extra legal costs, but it still allows us to, I think, reach a much larger audience. One constraint is that we're still limited to accredited investors. Now, our accredited investor can invest in an unlimited amount of money in our fund. What I think you're referring to is there's proposals that sometime in 2014, unaccredited investors could participate in crowdfunding of startups, real estate, our model. They could participate, but they'll be limited to, I think, somewhat what you stated, maybe 10% of their income. There's multiple restrictions, but let's call it 10% of their income. So they make $100,000 a year. They could then invest up to $10,000 a year in aggregate in these types of investments. And there's been a lot of talk in the industry, hey, is that going to be worthwhile? Because there'll be more restrictions, we have to already, right now, we have to verify that an investor is accredited. And in this case, with the using the unaccredited, there's even more verifications and checks that are required.
Right. I mean, one of the big things, and I've mentioned it on my show before, is that these private offerings have good and bad about them. The good thing, and I'm a big proponent in general, because I think generally you're going to find better returns here than you are, for example, in the stock market. But filing with the SEC and going through all of that rigmarole is extremely expensive. And so generally speaking, that's going to cut into returns of investors. And so that's one of the things I was asking about, because there's a lot of talk out there right now about with the current Obama Jobs Act about quote unquote, and they're using the words crowdfunding, and the crowdfunding is being described, I think, for people who have a net worth of less than the usual $1 million. And I think, they limit it to $2,000 or 2% is what I think that's what I remember what it is. The other issue is that you have to use various types of specific platforms that have been approved by the SEC to raise money. And obviously you're not doing that because you have your own platform. So anyway, this is, when we talk about accredited investors, once again, just as a reminder, that means that you have a net worth of either $1 million, or if you're filing jointly, you make $300,000 a year, or if you're filing alone, it's 200 or 250. Is it 200, Jorge?
It's single is 200, couple
Right.
is 300.
Right. But the good thing is, on the other hand, that even though you're making that money, it sounds like you're only having to invest $10,000. So it's not a terrible way to at least test this kind of market. And it is sort of, the thing I generally like about real estate, and the reason I'm in real estate is because it's backed by brick and mortar, and this is effectively backed by brick and mortar, right? I mean, you've got notes in the way, but you've got the first lien to the brick and mortar.
That's correct. So ultimately, the ultimate security is the real estate. I mean, if everyone didn't pay, ultimately we get the real estate. It may take some time. Foreclosure courts are still, in many cases, slow and backed up. But ultimately we would get the property, and that's the collateral for these investments.
And who do you sell that stuff to? How are you selling that? I might be interested in that stuff.
Yeah, sure. We end up there's a good percentage of the homes that the families don't want to keep. They'll give us the deed in lieu. They will foreclose, and those we typically just list with a local agent and then put it on the market and sell it. A local buyer is usually the best number for it, but we can certainly keep you let us know what you're looking for, and we'll keep you abreast as they become available. Because we do. I mean, right now we have more than 100 REOs across the country. It's a decent volume.
That's good. So I guess the other thing I was sort of curious about, which is a little different from your fund, is you kind of have these sort of fairly fixed numbers, right? I mean, 9, and I can't remember, was it 1 year for 9%, 2 years for 10 something, and then 5 years for 12,
right.
something along that lines. But how do you generally, I'm a partner in a fund myself, and we usually talk about preferred rates because we can't necessarily guarantee, we can't really guarantee that we're going to make 8%, but we're not going to pay ourselves until we generate at least 8% for a fund. How do you, because you're not calling it a preferred rate, you're talking about this is what you're going to get, right?
That's where you're going to get. It is. We do actually call it a preferred rate, but that's it. There is no additional sharing of the back end or anything like that. Our experience, we've been doing this now three years, is that we can generate 20% gross or a little bit better, somewhere in the low 20s. But that's gross before paying. We have more than a dozen employees. We have a decent overhead, and there's a fair amount of costs in doing this, in executing this strategy. So our ability to pay investors a blended rate between the three, it ends up being roughly 11%. There's more people into the 12%. We do that to give us some flexibility on the duration in case for whatever reason these were to take longer to pay off. But there's enough room to pay all that. It's not a stock play where a typical hedge fund, that 80-20 works because you have a bet of $10 million. If your bet, you make it 10 times larger, you make it $100 million. There's not too much extra work in making the bet larger. Here, if we buy $10 million worth of loans, that could be 500 loans. If we buy 100 million, that's going to be 5,000 loans, and that's 10 times as much work. So I think that's a big difference in why it didn't work that well. It worked out well for investors, but it didn't work out that well for us as a kind of standard hedge fund. And I could see some real estate groups, they'll do larger commercial projects. They do a hotel, a $20 million real estate project, $10 million real estate project, but it's all one project. I think there's some efficiencies which we just can't get to because we have so many assets, and they're geographically and there's not a concentration typically.
Right. So a couple other questions. So you obviously you can invest with an IRA. We had Dennis Blitz from the IRA Club on a couple weeks ago, and it sounds like this is something that you could easily use your IRA. It might be a nice play. Is there any reason you can't?
No, absolutely. A self-directed IRA is very welcome, and we have several investors that utilize their IRAs right now. The caveat is that Fidelity, Morgan Stanley, just as with real estate, many of the big custodians won't allow you to do alternative investments such as our fund, real estate, some of the other options besides the stock market or money funds. There's so yes, definitely 401ks also are more than welcome, in addition to IRAs as well.
Well, the whole model sounds really really great, and it's it's a little different. I think it's definitely something I think people should look into. Now, what is there any what are there any specific tax implications to this type of investing? I mean, is it just straight up? Is it just like getting passive income from stocks, or is it, or is there something special about it? I'm just wondering if there's any tax benefit because you're actually helping somebody out.
No, I wish there were, but it's not. You'll be taxed just like any other. You'll receive a K-1 at the end of the year. It'll mostly be ordinary income. There could be some capital gains in there, but it'll total the amount of whatever you received in gains from the prior year.
Got it. Well, very cool, Jorge. It's a sort of a socially responsible way to make money, which I think we're seeing a little bit more of, which is neat. And the minimum investment is not significant, so it certainly sounds like something that people should at least consider. If people want to get a hold of you, what's the best way to do that?
One of two ways. They can call 800-555-1055. They can email info at ahpinvest.com, or they can just visit our website and learn a lot from there, www.ahpinvest.com.
Great. Well, this has been really interesting, and thanks for coming on, Jorge. Hopefully, we'll talk soon.
All right, I appreciate you having me, Murr.
All
Good
right,
luck.
take care. Bye-bye.
All right, thanks. Bye.
That was a Wealth Formula podcast interview with Jorge Newberry of American Homeowner Preservation. Hope you enjoyed it. Just remember, I don't really advocate for any particular investments. I just want to let everybody know what's out there. I think it's a neat idea. Currently, I'm not an investor, and I don't have anything financially to gain from their fund. So anyway, I hope you enjoyed it, and I look forward to speaking to you next time. Make sure to visit the blog at wealthformula.com. Lots of good stuff there, and we'll see you next time.
Thank you for listening to the Wealth Formula podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.